High Mount Research Market Insights video, May 18th, 2023. Good afternoon, everybody. Willie Dowich here. Glad you're listening. It's Thursday. It's time for our Market Insights video, and we're going to call that from now on 3 for Thursday. Just 3 areas of the market to pay attention to focus on, to drill down into some details. So what are we going to talk about today? One, and a lot of talk this week about lack of volatility. We had 7 days in a row without a 1% move on the S&P 500, ended yesterday on Wednesday. See how that compares, that quietness compares to historically, given that we are also seeing weakness in the market beneath the surface. So that's one area. Second area, look at this ongoing disconnect. It's a little less of a disconnect between the Fed and the market in terms of where rates are going. And then we'll finish with a look at, from a global perspective, global equities have been leading. That some of that strength has started to be tested. So we'll see what we're seeing there, look at what we're seeing there, and then look at some implications for all 3 of those in the context of our macro-based relative strength ranking. So that's the path, 3 for Thursday. Let's get right into it. Here we're looking at a chart we've shown before. It looks at, on the x-axis, market strength, so it's a percentage of days with more new highs and new lows. On the vertical axis, it's market volatility, the percentage of days with 1% move on the S&P 500. What's different with this version is that we're looking at it by quarter, not by year. That gives us kind of I think a more honest ability to see what we're seeing in Q2 compared to Q1, and then also just relative to history. And it's really quite fascinating. Q1 is up here. It was 65% of the days had more new highs and new lows. About 45% of the days had some volatility. So it was both volatile and strong, not outside of the kind of the range here of the historical relationship between strength and volatility. The green lines there capture about 90% of the observations, again, going back to 1999, so almost a quarter century's worth of data. That brings us to what we're seeing in Q2 of this year. Here, we've seen both volatility and market strength collapse. We've had 3 7-day runs so far this second quarter without a 1% move in the S&P 500. Prior to that, we'd only had 1 in the past 5 quarters. So quite a difference this quarter versus last quarter. What we're seeing from a strength perspective, though, in the second quarter is more similar to what we saw for most of last year, where you consistently saw more new lows and new highs. We're at 31 days in a row coming into today, Thursday. That might change depending on how things finish this afternoon. But still, this idea of persistent weakness beneath the surface, even as the indexes push up against resistance, or in the case of some of the large cap NASDAQ 100 type indexes break out to new 52-week highs. Beneath the surface, we've got this environment of, and kind of a unique environment of quiet weakness, quite a bit different from last year, where it was noisy weakness. Quite a difference from earlier this year, where it was noisy strength. This quiet weakness, historically rare when we look over the past quarter century. What else are we seeing? This disconnect, this divergence that we've been talking about between the Fed, who talk about raising rates, keeping them high. This week, even talking about perhaps the need for additional tightening. That disconnect between what the Fed's doing and saying and what the market's pricing in, Fed, 2-year yield moving lower, even as the Fed has been raising rates. That's starting to change now this week. The market's starting to believe, I think, that the Fed is serious about keeping rates higher, might even have to continue to raise rates at their June meeting. That's the talk now among the Fed speakers, and those expectations for rate hikes at the June meeting starting to rise. The 2-year yield starting to rise, actually at its highest level now, close to it, highest since Silicon Valley Bank blew up in March. And so everyone's talking about the Fed should follow the lead of the market Right now, the market doesn't know whether it's coming or going, and it looks at this point to be going back in favor of what the Fed has been talking about, which is rates that are going to be higher than expected and stay higher than expected. That's a 2-year yield. That's a bond market catching up right now to what the Fed has been talking about. And then when we look overseas, this is of particular importance because global equities have been the leaders this year, really started last year, but we've seen so far resiliency out of global equities moving to new highs, global trends turning higher, even as US-based equity market trends continue to struggle. Well, that's getting tested now because the dollar has stopped going down. It hasn't started going up very much yet, but as it stopped going down, the percentage of world markets above their 50-day average dropped from about 90% down to less than 50%. Even the percentage above their 200-day averages is drifting lower. And so this strength we've seen overseas is starting to get a real test as dollar stability emerges, and global US weakness, whether it's macro related weakness or equity market weakness beneath the surface, we're seeing a flight to safety again in the dollar. Dollar improves, that puts pressure on global equities. So I don't think it's enough to challenge some of those long-term secular trends we've talked about, but in the near term, Europe, the UK, those have been very strong areas, and not be too surprising from my perspective if they cool down a little bit, if we get this flight to safety and start to see the dollar heat up again. So what can we do as investors? Well, we want to stay focused on relative strength. This is our look at relative strength from a macro ETF perspective. It kind of captures most of the broad areas: equities, fixed income, commodities. Leaders here, that's not surprising. That's Europe ex UK, United Kingdom, Japan. Number 4, that's gold. All 4 of those, if the dollar strengthens, could come under pressure. Gold already has started to weaken. You're starting to see some short-term weakness on a relative basis out of the UK and United Kingdom. So watch those areas to see if we get some pressure. Japan has been starting to improve, actually moving to new highs last week. That might be the rotation away from Europe and into Japan. In the US, this disconnect between what's happening among large cap value, large cap growth, both towards the top of the rankings, versus mid caps and small caps, both near the bottom of the rankings. US small caps made a new 13-week low last week. US large cap growth made a new 13-week high last week. And then if we're going to see bond yields continue to move higher, kind of follow what the Fed's doing, then I think we need to keep an eye on what's happening from a relative strength perspective for treasuries. Already long-term treasuries still near the bottom of the rankings, still in a long-term downtrend. Short-term treasuries, T-bills, expect those could start to improve a little bit on a relative basis if we get some of this rotation away from recent equity leaders, away from gold. Commodities broadly don't look like they're ready to do anything yet. Copper is breaking down, doesn't look particularly appealing right here. So watch the relative strength rankings, stay in harmony with the market, stay focused on price, not on narrative at this point. Especially as we've moved into the second quarter that is unique from historical perspectives, as we're seeing it's relatively quiet, but still relatively weak beneath the surface. So that's the Market Insights video for this week. Thanks for tuning in. Thanks for listening. Try to do these every week, every Thursday, kind of capture a few key charts in the market and then talk about them. And hopefully then you can share them with others as well. Willie Delwich here. Thanks for listening. Hope you tune in again next week. Have a good week, everybody.